Broadcom may be about to prove that the next AI chip war will not be won only by whoever builds the fastest processor. It may also be won by whoever can finance the customer buying it. According to Reuters, Broadcom is seeking more than $60 billion in new debt for an AI financing program that could ultimately raise as much as $100 billion. The money would support companies building massive AI infrastructure around custom chips, including Anthropic. Broadcom already participated in a separate $35 billion financing arrangement earlier this year to help expand Anthropic's computing capacity. Now the company appears to be scaling that strategy much further. The timing is important because AI infrastructure has reached a strange stage. Demand for computing remains enormous, but the companies buying that computing are beginning to need financial structures as ambitious as the technology itself. A frontier AI laboratory may want several gigawatts of capacity, but building that infrastructure can cost tens of billions of dollars before the first useful token is generated. The processors are only one part of the bill. Customers also need high-bandwidth memory, networking, cooling systems, land, electrical connections, buildings, and long-term power contracts. Broadcom's answer is to turn AI hardware into something Wall Street can finance. That changes the competition with Nvidia. Nvidia became dominant because its GPUs were flexible, powerful, and supported by CUDA. But the more expensive AI infrastructure becomes, the more customers care about cost per useful unit of computing. Custom accelerators can be designed around a specific model or workload and may deliver better efficiency than a general-purpose GPU. Broadcom has built a large business helping hyperscalers design these application-specific chips, and it now appears to be adding financing as another part of that offering. Imagine two suppliers trying to win a giant AI contract. Supplier A says, "Here is the best chip, pay us." Supplier B says, "We will help design the chip, help organize the networking, and help structure the financing that lets you deploy tens of billions of dollars of hardware." Even if the raw processor performance is similar, the second offer can be much harder to refuse. That is why Broadcom's debt plan matters. Reuters says the proposed financing could include a junior debt tranche of roughly $30 billion and a senior secured tranche of $60 billion to $70 billion. The total could therefore approach $100 billion. The debt would reportedly be issued through a special purpose vehicle rather than sitting directly on a customer's ordinary corporate balance sheet. This kind of structure allows investors to finance a specific pool of AI infrastructure and receive repayment from the cash flows associated with those assets. This may sound like financial engineering far removed from artificial intelligence, but it is becoming central to the industry. A few years ago, the most important question was who had access to enough GPUs. Today, the question is increasingly who can finance enough computing power to matter. Anthropic is a good example. Claude is growing quickly, but Anthropic does not have the same balance sheet as Amazon, Microsoft, or Google. It needs enormous quantities of compute to train future models and serve agents that may generate hundreds of inference steps from a single user request. Earlier this year, Broadcom, Apollo, and Blackstone reportedly arranged roughly $35 billion in financing to support Anthropic infrastructure. That project was initially designed to add around 1 gigawatt of computing capacity, with a much larger long-term target. 1 gigawatt is already extraordinary. It is roughly the continuous output of a large power plant. When AI companies talk about eventually operating tens of gigawatts, the discussion has moved well beyond ordinary cloud computing. These are industrial projects closer in scale to national infrastructure, and that is where custom chips become strategically attractive. A model developer like Anthropic does not necessarily need one processor capable of running every workload on Earth. It needs hardware that runs Claude efficiently. If Broadcom helps design an accelerator specifically around Anthropic's models, memory patterns, and inference behavior, some unnecessary flexibility can be removed. The customer can optimize the entire system around its own workloads. This is especially valuable for inference. Training receives more attention because it creates the model, but inference happens every time the model is used. An agent may read documents, search databases, execute code, call tools, compare results, and retry failed steps. that can turn one user request into dozens or hundreds of model operations. Small efficiency improvements become enormous when multiplied across billions of agent actions. The economics are straightforward. If a custom accelerator reduces the cost of one operation by only a few percent, the saving may appear small. Scale that across gigawatts of infrastructure and years of continuous use, and the value can become billions of dollars. Broadcom is betting that AI companies will increasingly prefer this specialization. Nvidia remains the strongest competitor because its ecosystem is difficult to replace. CUDA allows developers to run a wide range of models and tools without rebuilding their software stack from scratch. Nvidia also sells networking, rack-scale systems, CPUs, and complete infrastructure platforms. A custom chip may offer better economics for a stable workload, but it can create engineering costs and reduce flexibility when models change. That trade-off matters because AI is still evolving extremely quickly. A processor designed around today's Claude architecture may be less efficient if Anthropic radically changes how its future models reason, use memory, or communicate between experts. GPUs remain powerful because they can adapt to unexpected developments. A specialized accelerator is most valuable when the workload remains predictable enough for optimization. Broadcom, therefore, does not need to replace Nvidia everywhere. It needs to win the workloads where specialization matters more than flexibility. And financing can make that transition easier. An AI company considering a custom chip faces several risks. It must spend money on development before the processor exists. It needs manufacturing capacity. It needs memory, packaging, networking, software, and data center space. Then it must deploy enough units for the economics to make sense. A large financing vehicle can absorb some of that burden. It converts a huge upfront capital requirement into a longer stream of obligations supported by the infrastructure being built. This is similar to how airlines finance aircraft, telecom companies finance networks, and utilities finance power plants. AI is beginning to look more like those industries. That may be one of the biggest changes happening beneath the current model race. Software traditionally scaled cheaply. Build the product once, then distribute copies around the world at low marginal cost. Frontier AI does not behave that way. Every answer consumes hardware, memory, electricity, and cooling. The more successful the product becomes, the more physical infrastructure the company needs. This means AI growth can become capital constrained even when customer demand is strong. Broadcom's potential $100 billion financing program is an attempt to remove that constraint. But it creates a new risk. Debt does not make infrastructure cheaper. It changes when and by whom the bill is paid. Someone still needs enough revenue to service the financing. If AI demand grows as expected, lenders receive returns. Broadcom sells more custom silicon, customers gain cheaper computing, and the structure looks efficient. But if inference prices fall faster than expected, if models become much more efficient, or if demand slows, the same infrastructure can become harder to monetize. This is where the custom chip boom becomes connected to the broader AI debt story. Nvidia has already been drawn deeper into customer financing. Google has created equity-linked incentives with Marvel. Amazon and Microsoft are making enormous long-term infrastructure commitments. Private credit firms and asset managers are becoming increasingly involved in data center projects. Broadcom's plan pushes the trend even further by potentially creating a giant debt vehicle specifically designed to help customers buy custom AI hardware. The suppliers are no longer just selling chips, they are helping build the financial system around the chips. That can accelerate competition with Nvidia because Nvidia's greatest commercial advantage has been that everyone needed its hardware immediately. If Broadcom can offer a credible custom alternative and make the financing easier, customers gain more negotiating power. A hyperscaler or AI laboratory could use Nvidia GPUs for frontier research, Broadcom-designed accelerators for stable inference, another custom chip for networking, and different hardware for storage or pre-processing. The future data center may become increasingly heterogeneous. This is bad news for any supplier hoping to control the entire stack. It is also potentially good news for AI customers. Competition can reduce costs. Custom chips can improve energy efficiency. Multiple hardware architectures reduce dependence on one supplier. And the need to justify enormous financing commitments may force companies to focus more aggressively on measurable economic value rather than benchmark headlines. The problem is that the financing itself can create pressure to keep expanding. Once a company has committed billions of dollars to a custom architecture, it has an incentive to keep using it. Once investors have financed the infrastructure, they depend on future utilization. The system becomes more difficult to change quickly. This creates a tension between financial stability and technological flexibility. AI architectures can evolve in months. Debt may mature over many years. That mismatch could become one of the largest risks in the next phase of the industry. Suppose a new model architecture suddenly cuts inference requirements by 70%. That would be excellent technological progress. But infrastructure financed under the assumption of much higher compute demand could generate lower returns. Better AI can therefore create worse economics for some of the companies that financed the previous generation. This is not hypothetical. The industry has already seen dramatic improvements in model efficiency. Mixture of expert systems activate only part of a model. Distillation can transfer useful capabilities into smaller systems. Specialized inference models can complete routine tasks much more cheaply than premium frontier systems. Better software can increase utilization without adding another chip. The financing market must therefore make a difficult bet. Will falling cost increase total AI usage so much that compute demand still rises faster than efficiency improves? Broadcom clearly believes the answer could be yes, and there is a strong argument for that view. When computing gets cheaper, people usually use more of it. Personal computers became cheaper and spread into homes. Cloud computing made servers easier to access and created vast new software industries. If AI inference falls dramatically in price, companies may embed agents into every workflow, device, website, and business process. Lower cost can expand the market faster than it reduces revenue per task. If that happens, $100 billion of financing may not look excessive. It may look like the beginning of a much larger infrastructure market, but that outcome depends on AI agents becoming economically useful at scale. Companies need agents that complete work reliably enough to replace or amplify human labor. They need fewer retries, fewer hallucinations, better security, and predictable costs. The hardware can be available, but the software must create enough value to pay for it. This is why Broadcom's financing plan is not simply a chip story. It is a bet on the entire AI economy. Broadcom is betting that custom accelerators will become important enough to justify tens of billions of dollars in dedicated financing. Lenders are betting that customers will keep using those systems long enough to repay the debt. Anthropic and other AI companies are betting that future models and agents will generate enough revenue to justify infrastructure measured in gigawatts. And Nvidia is watching as the market it created becomes more complicated. For years, the simplest way to scale AI was to buy more GPUs. The next phase may look very different. Design the chip around the model. Build the infrastructure around the chip, and bring Wall Street in to finance the whole machine.